All right, we're gonna get started. Or not. Yeah, some people watching on Zoom who are logged in, so we're gonna get started. My name is Stephen Bennett. I am the programs chair again. Last year doesn't count, that was a holiday, so technically my third year as programs chair. So thank you all for coming, and I want to welcome you back. We returned to live events last month, and it was a long process. I want to thank my fellow board members for putting this consensus and hosting this space. We are very lucky. I talked to other societies like in San Diego, they're hoping to come back in December. So the fact that we can return is, I'm very grateful for that. It allows an opportunity to network, hear speakers, and socialize. And thankfully, we're not in Boulder where we have to wear masks. For a show of hands, how many of you heard of the Member Resource Network? Has anyone? 3 people, okay. This is an initiative we started rolling out last year, for lack of a better term. It's an internal bulletin board. There's an app on your phone. When you get the connections, monthly email, there's a link on the bottom to join. I want to encourage y'all to check that out. It's not only a way for you to network, but all of our social events and my program events will be on there. We've learned that there's a problem with some emails getting through to people. We did a top of a golf event last week. 50% of the members there in attendance had heard this was coming. So what we've learned is a lot of email is going to other on Outlook or spam on Gmail. So it's another way to stay in touch with what's going on in the society. And make sure you're on LinkedIn and check out the Member Resource Network. We will have monthly programs like this for the indefinite future, COVID permitting, and likely monthly pure Zooms as well. So just want to make sure you miss out on anything. And finally, I'd like to thank State Street Global Markets for sponsoring today's event. Their sponsorship allows us to offer low-cost programs to our members and provide valuable content. One of my first programs 2 years ago was with Lee here at the Country Club, and I find him very entertaining, and his insights, he's very knowledgeable, perhaps it's the accent. And then he also hosted a webinar for us, early Zoom. So I really value State Street. Thank you. Without sponsors like State Street Global Markets, we wouldn't be able to put on content like this. So with that, Lee's going to speak. There's going to be a Q&A at the end, and do you want me to ask questions throughout? Or?
They can, yep, absolutely.
Okay. We have a hard at 4:15. I borrowed the novelty large cane from the Country Club and be yanking them off the stage. So if you don't get a chance to ask a question during the presentation, we have this room for 45 minutes at the end. There'll be hors d'oeuvres out there. The bar will be open. Unfortunately, you can't be outside, but if you don't get a chance to ask your question, follow up with Lee during the social hour. With that, I'll pass over to Lee. Thank you.
Is in. That we can get another variant as long.
We'll talk more about that later as well. Boris can come up. But yeah, so they're still there. We saw them come down and then we get this ramp up again. And this is my concern over the US. Second sort of myth is, oh, well, what happened was when cases got worse in those lowest 10 states, people rushed to get vaccinated. No, they didn't. There was a little bump up in weekly vaccination rates, but now it's the lowest it's ever been. So new people going to get vaccinated in those states is lower than it's been at any point since the vaccine started. It's not, they're not going to get to herd immunity at 70%, not anytime soon. And this is the concern as we move into winter. And so these charts here compare this year to last year. And you can see at this stage last year how the cases started ramping up as we went into fall and then into winter. US cases falling now, but look what happened last year. And this is why I pointed out the EU. Look what's happening there. They're starting to edge up. Now, the EU is 70-75% vaccinated. But as the winter comes, as the cold weather comes, you're starting to see things move back up again. And this is my concern going forward, that this is going to impact activity. And people come out and say, well, we're not going to have lockdowns. We're not going to have restrictions. We're not going to go back to where we were. No, we're not. But it's already hurting activity. If you look at this data, so this data comes from Google. It's mobility data. It's tracking you and your phones and where you're going. Yes, you do it. I guess you can turn it off. I don't know how to, but they do know what you're doing. It comes across a whole range of things. This is mobility related to going to retail and recreation activities, right? So I took June the 1st as sort of a base case. You look at 4 high vaccination states: Massachusetts, New Jersey, Pennsylvania, California. Mobility has improved since then, compared with the baseline of Q1 2020. Right, California not so much, that's Jill's fault. But aside from that, you look at Massachusetts, New Jersey, Pennsylvania, retail and recreation activity has improved. You look at 4 low vaccination states: Florida, Georgia, Tennessee, Texas. Retail and recreation activity has declined since June. This was meant to be the big reopening. This is where everyone's back out and meets up in rooms together and everything else. People are moving less in those states. Similarly, when we look at public transport, so this is use of transit, same story, right? Not as pronounced, but a similar story. And transit usage is basically a proxy for workplace attendance, right? People get public transport to go to work. And what you see, it's improving in some, but then in those low vaccination states, it's getting worse. I mean, we see it in the real data as well. The last two payroll reports have been extremely disappointing. They've been disappointing because the reopening sectors are not hiring, right? So retail and food services, bars and restaurants, had the big reopening. Look at the last 2 months. And this isn't just because of lack of staff. Yes, there's a lack of staff, and I'll come on to that a little bit later on as well. But in August, food services, restaurants and bars actually got rid of people. They closed back down, foot traffic went down on average across the US. We had a little bounce last month, but this again is not the grand reopening we were promised. And you look at growth expectations for Q3, so the blue line there is from the Atlanta Fed. This is their nowcast. They take all the data and they have this rolling sort of real-time estimate of activity for Q3. Look where we were. We expected to be growing 6% seasonally adjusted annualized rate in Q3. It's now down to 1.3. Now, I think their model is overplaying the weakness a little bit, but it's certainly going to be worse than the consensus in the market, which is just below 5%. It's not going to be anywhere near that because people still aren't factoring in how COVID in these places is still impacting activity. And that's why a few months ago, a few weeks ago maybe, we passed peak growth optimism. This was meant to be the perfect reopening. Everyone came back, growth was going to surge. And that was, that was where we were. But look at these growth expectations. So this is a change in growth expectations 2021 since June of last year. It was all upwards, particularly in the first quarter of this year, when what we saw was, what happened with the Georgia runoff. So therefore, the Dems got the balance of power. They got the 50-50 in the Senate. So therefore, there was all that optimism on the fiscal side. Got the fiscal package in March. All that boosted growth optimism. But look at the last couple of months. The expectations are coming down. They're coming down in calendar as well. UK is holding up. For the life of me, I don't understand why. EU is sort of back to flat. But the fact is that the peak growth optimism, we've already passed it for this year. Now, the markets got there a little bit early. People were, sort of confused by the sell-off in rates at the long end, sell-off the decline in yields, the rally in rates at the long end. Actually explained by growth expectations. The market moves ahead of the economists, right? So you can see here, I've plotted here, the orange line there is expectations for growth for 20 and 21 combined against the 10-year yield. And you can see, but I've got a 1-month lag on the consensus growth expectations because it moves more slowly. You can see how perfectly it fits in with yields. Apart from the latest move higher, which I think will be temporary. I don't think rates are going to go careering higher from here. We can talk more about that later as well, because it doesn't fit in with the fundamentals. Look at how those two lines track until this move up we've seen over the last few weeks. That's overdone, because you're not going to see growth expectations go back up from here. They're going to go down further. Similar story. Get that on Zoom as well. Similar story when you look at equity markets. So this is comparing the performance of the NASDAQ against the Russell. So why am I doing this? Because people talk about the reflation trade. They really don't understand what they're talking about. There are two phases here to the recovery that we've seen. The first phase was sort of in terms of markets and not growth. So the first phase was from March onwards last year. So there you had massive policy support, but growth expectations were going down. So the blue line here, the light blue line, is this 20 and 21 growth expectations combined, but on the right-hand scale inverted. So as that light blue line goes up, growth expectations are going down. So you have this period of massive policy support, but growth expectations are actually declining. That led to the duration trade. You buy the NASDAQ, you buy the large cap tech stocks, right? It's all about future growth, future earnings, not about the now. So it outperforms the mid caps, the Russell, because that's all about growth now. Those are the companies relying on growth now. Then around last summer, we sort of saw, growth expectations bottomed out, started to turn, and you saw the reflation trade. So that first phase is the duration trade. Then you have the reflation trade. And that coincided with the vaccine rollout, then Georgia, as I said, and the fiscal package in March. That's when the Russell started to outperform the NASDAQ. But again, look what's been happening more recently. We've gone back to the duration trade because growth expectations have come back down. And if I'm right going forward, what you're going to see is the duration trade is going to dominate over inflation in the next few months and quarters. Because looking ahead into 2022, there's something here that doesn't add up as well, that people aren't factoring in. And that's the fiscal cliff. And I'm talking about whether Biden gets the package through, the 3.5 trillion, et cetera, it's clearly not hit the 3.5 trillion, but even if that comes through, that is not a fiscal stimulus package. It's got to be budget neutral. So it comes with tax increases, right? It's not like the packages, the emergency packages we had that were not funded. This has to be fully funded. That's the whole point. So even with that package, this is where fiscal policy will be in terms of its impact on growth. So you see the top chart from the Brookings Institute. This is the contribution to GDP growth from fiscal. You can see the huge boost in 2021. This is what we're going into in 22 and 23. In actual fact, if you look at it from an annual perspective, this shows you here the 12 biggest fiscal cliffs since 1930, I think. Yeah, 1930. Right, so this is the change in the budget deficit from one year to the next year. Still going to be a deficit, but it's just you're going from 10% deficit to a 1.8% deficit. 2022 will be the biggest fiscal cliff, the second biggest we've ever seen. The only one that was bigger was 1946. And yet, when we look at growth expectations for next year, this shows you the top 30 growth years since 1950, I think this time. Yeah. 2022 is supposed to be the 26th best year of growth we've ever seen. But we're going to have the second biggest fiscal cliff we've ever seen. And it comes after 2021 growth expectations, which are there. That's going to come down as well. But the fact is, people are not factoring in the fiscal drag that we're going to see next year. And I can show this on a scatter as well. So there's, forget the mess in the middle. But this is, growth expectations, or actual growth in terms of 2022's growth expectations against that change in the budget balance. Look, we've only had 1 year where the fiscal drag was bigger than it's going to be next year. 1946, growth collapsed. I mean, there was other stuff going on at the time. The only other one that's similar is 1947, again, negative growth. Now, I'm not saying we're going to recession next year, because I don't think we are. But 4.1% growth expectation for next year with that fiscal drag? No way. There's no way we're getting that level of growth. And this is why I favor the duration trade over reflation, because growth expectations are out of whack with what's going on in the real world, and they're going to have to adjust when people factor in that fiscal drag. I don't know why they haven't done it already. Let's be honest, the economics field has not had a great 18 months because models are based on basically what happened before and we're expected to happen again. We've gone through a pandemic, we've never seen it before. Economists are flying blind. So, and a lot of them, if the models don't work, they don't actually apply the real world to what's going on. This is the real world, and that's what's going on. Does that make me bearish on markets overall then? No, probably the opposite. Because the key thing is, the relationship between asset values, market performance, and fundamentals, that left the building a long time ago, right? It's all about policy and policy support. That's why 2021 was one of the worst growth years in history, and yet we had 25% negative market returns because of policy. So if I'm right that growth disappoints, then actually the policy support remains. So you look at the Fed's balance sheet, we've gone from 4 trillion at the start of the pandemic, we're at 8.5 trillion now. There's the fiscal stimulus. You can see how, look at the 12-month rolling fiscal deficit, that we're already moving up into that fiscal drag. But the fact is, policy support will stay for longer. When you have this much policy support, you have the most accommodative financial conditions in history. I mean, this index is Goldman Sachs one only goes back to 1990, but I'm going to guess that when Goldman was raising rates to 15% in the 80s, financial conditions weren't as good as this. So the fact is that financial conditions are going to stay loose. And that's going to keep volatility low. As long as there's liquidity, volatility will be low and assets can continue to perform. And that's because of slow growth, not in spite of slow growth. Yeah.
Quick question along those lines.
Yeah.
So things we saw now, yeah, rates go low, the Fed's very accommodative. When we sort of saw, most recently, assets went to the moon. But kind of table that, there's no inflation. Yeah, you can make a strong argument, or you can make an argument that, all the stimulus is in the financial system is driving asset prices, and we're seeing knockdown effects of that across over social unrest. I think the Fed will start listening to the social unrest argument that, hey, the more you loosen rates and drive asset prices, the greater wealth divide, the more unrest that you're making, or they sort of pigeonholed in.
Let me come back to that, because I'm going to talk about the Fed in some depth in a minute, and I will touch on that then and sort of try and explain my thinking behind that exact point.
Cool.
But overall message, listen, everything's gone up because of liquidity. And generally, markets are going to continue to perform well over the coming months. It's going to be harder because they are going to taper. So back to your point, the slowing growth I'm talking about now really means more for rate increases going forward, and I'm going to come on that in a minute. But it also means the taper is going to be slow. Now, the market's we're going to start in November. I think that's pretty much nailed on. But there's sort of markets pricing in middle of next year finished. If there's a risk that middle of next year timetable, my point is it's later, not earlier. Because if these growth numbers come in as I expect, the Fed will taper more slowly, and that will be a positive for asset prices. And certainly that's what real money investors think about. Those who've heard me speak before, you will know State Street, we custody around $40 trillion in assets. And for the last 25 years or so, we've produced a range of indicators based on real money flows, what they're buying, what they're selling across asset markets. And from that, we sort of, a lot of our research is based on that. This chart here, it's a bit of a mess, but this chart here shows you real money sentiment based on what they're buying and they're selling. Are they buying high risk assets? Are they selling safe havens, that sort of thing? We add it all up and we get a measure of sentiment. The point here is sentiment is still very positive. It's had a couple of wobbles over the last 12 months, but it's still positive, and it's positive today. Even with the market wobbling that we've seen over the last month or so, real money sentiment is still positive. The two biggest drivers of investment decisions over the last 18 months and will remain are FOMO and TINA. Fear of missing out, and there is no alternative. And so long as the Fed is providing support, which I think they will, they're going to start withdrawing it, but it's going to be a much slower process than people think, then FOMO and TINA will continue to be the main drivers of investment decisions. Now, there is, of course, one thing that can mess up this whole scenario, and that is inflation, right? So the one thing that brings the whole house of cards coming down is if the Fed is forced to act because of inflation. So we get to the transitory or persistent debate. This is the one everyone wants to talk about. So, we have an insight here as well that other people don't have, something called price stats, which hopefully some of you are familiar with, but this is our tie-up with academics at MIT and Harvard. We basically track 10 million prices a day on the internet, and from that we can produce daily inflation measures for 23 different countries. So rather than CPI, which comes out with a sort of 6-week lag from the start of the month, this is with a 2-3 day lag. So this chart here shows you the official inflation, the BLS. The light blue line is what will happen if we have average inflation prints over the rest of this year. And then the dark blue line is our price stats. A lot of the reopening categories that caused the big inflation spike were not online prices, like used cars, etc. But the same trend is there, and you can see what price stats is doing now. And what actually headline prices will do as well the rest of the year is they're going to go fairly sideways at a high level. Does this mean it's persistent? No, it does not. Right? And this is the problem with the persistent against transitory debate. People don't define it properly. Transitory is not really a time element here. Transitory means that these price pressures will go away on their own without the central bank having to hike rates aggressively in order to trigger a recession to reduce demand in order to get prices down. Transitory means it will happen on its own without the central bank doing anything. Persistent means that we have an unstable system, that higher prices this year will lead to higher prices next year, will lead to higher prices the year after, and will keep going up. That's not where we are. We have a number of supply side shocks. It's not all base effects. You know, if I start at 100, and this is using price stats from 2015, so the orange block is the high-low range from 2015 to 2019. You see what happened in 2020, so you've got a base effect there because of the collapse in prices last year. But even without that, if I start from the beginning of this year, look, we're way above what we've ever seen before. So it's not just base effects, there's a lot more to it than that, and there are these side issues. Yes, there are, and there's reopening prices, etc. But all of them will go away on their own. They're not going to lead to higher prices. The fact is, we're already starting to see it. So if you look at monthly CPI, so used car prices, right, already started to drop. They popped up again this month, but they've already started to drop overall. Other reopening sectors, which are like, you know, bars and restaurants, etc., saw a big fall in prices last month. So what you see is the monthly CPI is already coming down. You can look at specifics. Remember back in March, April, everyone was worried about lumber prices. Lumber prices are 20% lower now than they were at the start of the year, right? It corrected on its own. There was a shortage. It was COVID related last year. You saw demand come down. Now we've got European gas prices. Yes, lack of investment over the last 18 months. Putin playing games with Europe. That's part of it. They will come down the road as well. Yellow peas is the latest one, by the way. Do you think yellow peas are important? If you like Beyond Burgers and stuff like that, it's the main ingredient. And yellow pea prices are through the roof at the moment because of a drought in Canada, right? But again, all these things will come back down. Because the thing is, even if the Fed did hike rates, that doesn't create rain in Canada, right? It doesn't bring yellow pea prices down. So really, it's pointless for the Fed to try to, for people to think about tighter monetary policy to tackle supply side constraints. It doesn't do that. It tackles demand. Demand isn't the problem, it's supply side. And it's not just in the US as well. We can do the same thing, the same chart around the world. So Eurozone, UK, Canada, even Japan's got inflation now. You know it's transitory if Japan's got inflation, right? They haven't had inflation for 30, 40 years and they've got it now. So you know it's transitory. And the thing is, again, it's already coming off. You look at year-on-year rates and price stats. US and Canada have sort of peaked. US and UK have peaked. Canada's heading back up. Look at Euro and Japan, as I said. But look at the monthly changes. They're settling back down to a much more normal range. Now, monthly for the rest of this year doesn't bring down the average monthly for the rest of this year does not bring down headline CPI. Average for the first half of next year really brings it down fast because all those reopening prices came sort of March through to June, July. So if we get average inflation in the first half of next year, you'll see headline CPI crash quite quickly. But the real reason I think is transitory, and the real key here, the difference between transitory and persistent inflation is the labour market. Everything comes back to the labour market. And this is what the Fed thinks as well. So I'm just sort of going to tackle the question you asked. We have a different Fed framework now than we've had before. Right. Jackson Hole last year, they unveiled this new Fed framework where they go to average inflation targeting. That wasn't the biggest change though. The biggest change was in the labour market targeting. So before the Fed's dual mandate, they targeted full employment. So full employment was defined as NAIRU, the non-accelerating inflation rate of unemployment. Now the Fed is targeting maximum employment. And maximum employment is this more opaque measure of unemployment rate, wages, participation. It's a whole thing. There's no one number. But it's not just, they're not just targeting the unemployment rate or the maximum employment for the aggregate for the economy. They want to do it by each individual sector, by gender, by race, by educational level, by income level. They're trying to do it that way. So why are they doing that? Why is the Fed trying to take on this sort of this labour market in this way rather than just having one number they had before. Because of inequality. And this is the driver. It's not, and here again, it's not that the Fed are trying to tackle inequality per se, but the Fed has realized that inequality is the reason why, or the reasons behind the inequality are the same reasons as to why we've undershot on inflation for the last 10, 20 years. So this is inequality in two charts. So share of income going to the bottom 50% or the top 1%, and then share of income going to the middle class, 50th to 90th percentile or the top 10%. And you can see the trends. Focus on this chart here. Really what we see, inequality has been rising since the mid-1970s. But the first 20 odd years of that, no one cared. Because in the first 20 odd years, from the mid-70s to the late 90s, actually what you had was the rise in inequality happened, but everyone was better off. Real incomes went up for everyone. This was deregulation, this was Thatcher, this was Reagan, deunionization, deregulation, all of that. Real incomes rose for everyone. They rose quicker for people at the top, but that was seen as aspirational. It wasn't a problem. The last 20 years has been very different. So the last 20 years, inequality has risen, but people at the lower end have not seen real incomes rise. So change of real incomes from 99 to 2019, bottom 20%, no change in real incomes for 20 years. If you go up to the 16th percentile, so the majority of people, 10% change in real incomes over 20 years, 0.5% a year. So that is the real crux here. Because, why has this happened? Because the last 30 or 40 years, there have been structural changes in the labour market that have all shifted power from the employee to the employer. So demise of the unions, the deregulation I talked about, Thatcher and Reagan. Then from the early 1990s, globalization. Right? You're not competing with the guy next door for a job, it's people around the world. And then the last 10, 15 years, it's technology. You're not competing with a person, you're competing with technology. All of that shifted power from the employee to the employer. And that's kept wages down for the vast majority. And that's why inflation is transitory. Because the only real form of inflation is a wage price spiral. But higher prices lead to higher wages, which lead to higher prices, because inflation is about power, pricing power, the ability to pass on. And if there's no pricing power in the labour market, ultimately there's no pricing power in the goods and services market. Because if prices go up but incomes don't, people can't buy stuff. So demand goes down. And we hear a lot about the labour market now, and I'm going to touch on that issue as well. But I don't think that balance of power, that 30, 40 years and that balance of power in the labour market has changed during the pandemic. In fact, I think it's gone the other way, and I'll explain why. But the fact is, if you don't have rising real incomes, you can't have increases in demand. So you look at US consumption growth from 67 to 2000, averaged 4%. From 2000 to the pre-pandemic, averaged 2%. Because if income's going up, demand can't go up, right? And if demand doesn't go up, and that was the biggest problem post-financial crisis to the pandemic, was a lack of demand. And if you don't have demand, you don't have pricing power. And that's why when you look at core PC inflation, we haven't been above 3% since the mid-1990s. Funnily enough, that 20 odd years I'm talking about. We have now. It's not going to last because wages aren't going to go up sufficiently in order to create that wage price spiral, which is the only real form of persistent inflation. Now, we hear, these shortages in the labour market now, and people can't hire, etc., etc. That's temporary. People are living on their savings. They're worried about coming back because of COVID. Schools have only just gone back. I do think these 5 million people, we have 5 million less people working now than we did pre-pandemic. They haven't all retired, all right? And even though some have, we've got kids leaving school and kids leaving college, all right? People retire all the time. That's the birth-death model. So I don't believe that's the factor. Now, these are uncertain times, and I could be proved wrong, but I don't believe that balance of power in the labour market shifted. And I actually think that what's happened in the pandemic is that balance of power in the labour market has actually got more in power of the employers. And I'll tell you why, because if there are two big economic sort of trends that are likely to persist from the pandemic, or two social events that are likely to persist, right? One is work from home, right? And the other is online shopping, right? So retail, leisure and hospitality employ just over 20% of people in this economy, right? They're two of the lowest paying areas, and you can see the unemployment rate by education level as well. The two areas of the economy in terms of the labour market that are going to be most affected post-pandemic are retail, leisure and hospitality. So leisure and hospitality, people working in restaurants, bars, etc., etc., etc. If all of us work from home 1 day every 2 weeks, more than we did pre-pandemic, that's a 10% reduction in footfall in city centres, right? That's 10% less people in coffee shops, sandwich bars, bars and restaurants in the evenings. Because if you're in your house, you make your own sandwich, you make your own coffee, right? And you get a beer out the fridge, right? So these people, and that's 1 day every 2 weeks. People are going to be doing more than that, this hybrid system, 2 days, 3 days, whatever, right? That's the first thing. The other is online shopping, right? Even before the pandemic, retail was losing jobs. This is the change in number of people by sector in payrolls in the 3 years prior to the pandemic, Jan 17 to Jan 2020. Only area that lost jobs was retail, brick and mortar retailers. And we know they lost it to online, right? This is what's happened during the pandemic. So this is retail sales. It's the percentage change since Jan 2020 by retail sales sector. This is the number of people employed in those retail sales sectors. Retail sales are up nearly 15 to 20% since the start of the pandemic. Employment in retail is down about 5%. And you can see it by, non-store, online, yes, Amazon, etc. But these other areas, look at clothing, right? These companies, these retailers have invested heavily now in their websites, in their infrastructure in terms of delivery and everything else, right? Some people will go back to the shops, but not everyone. People have learned how much you can order online. I am on first name terms with the Amazon guy. I think I'm going to be godfather to his children, right? And I'm not alone. So yes, people will go back to shops, but not to the extent they were before. This was already a trend in place anyway. It's been massively accelerated. The retailers want it because they have higher margins from this. And this means less people working in retail as well. So what does this mean? I'll let myself some time. What does this mean for the dollar and markets? Rates. I touched on rates before. I don't see them going up much from here. If I'm right about the growth numbers and everything else. So you look at my rates, they're made up by two things. Break-evens, which are inflation expectations, and real rates, which is basically the expectations on the Fed. I didn't get to on the Fed actually. Well, I should say on the Fed, when it comes to rates, they're not hiking in 2022. I don't think they'll hike in 2023, right? Maybe we'll get one in 24, but the rate hikes, remember after 2009, after the financial crisis, how we get pushed out, pushed out, pushed out? We're here again. And the fiscal drag this time is even bigger than we thought. If I'm right about the labour market taking much longer to heal, we're going to go back to that pattern where these rate hikes just get pushed out, pushed out, pushed out. Yes, there are some on the Fed who are still old, who still believe that inflation is persistent. They're not the real thinkers. They're not the Washington people. The Washington people, the Brainards, the Powells, the Floridas of this world, they're in the camp that actually rates down all through 2023. So that means long-end rates can't go much higher unless we're going to price the Fed losing control of inflation, and we're not there, right? We've seen a tick up in inflation expectations the last couple of weeks. That's energy, but again, energy is a tax. It's not really inflation. It's a tax on future growth. Real rates bounced a bit after the Fed, but they've settled down again now. If I'm right on growth missing, then actually long-end rates are not going to go up much from here. Maybe we can see 175 on the 10-year, maybe a little bit higher. I think we'll settle back down towards the 150 level on the 10-year. For the dollar, this spells trouble for the dollar. We still have the trim deficits issue. We still want to fund a current account deficit. And if the Fed's not hiking, that gets harder because the US funds its current account deficit through fixed income inflows. People buy US debt. This chart here shows you a Eurozone investor and a Japanese investor. If they buy 10-year treasuries, they hedge their FX for 3 months. This is what they earn over and above their domestic risk-free rate. They're earning about 1% hedged. So why wouldn't they buy the bonds hedged? They will. So if they buy them hedged, then we don't fund the current account deficit through fixed income flows because they're FX hedged. The US has a basic balance deficit, which means the dollar has to go down over the medium term. We have a way of measuring it. It's called a fixed income hedge ratio. This is from our real money data again. This is overseas buyers of US treasuries, how hedged are their portfolios. It's the blue line there. So on the chart over there. So as that blue line comes down, I plot it against the DXY, which is on the right-hand scale inverted. As the blue line comes down, as they guess, which they did from 18 through to 2020, because these were negative, they couldn't hedge, so the dollar goes up. What we've seen since March last year is that blue line going up. It's been volatile, but the trend is upwards in that blue line. Increased hedge ratios, as they should be, because they can, means the dollar goes down. We have a basic balance deficit, and that means the dollar has to go lower. Now, it's volatile. We're seeing spikes. These are the flows, 20-day flows and holdings in the dollar, and you can see these big spikes. It's the ultimate safe haven currency now. If things are uncertain, real money runs to the dollar, you get rallies like we're seeing now. Over the medium term, the dollar is going to drift lower, drift lower, drift lower. There will be bouts of strength. But if you think about the medium term, euro dollar, dollar yen, etc. For me, euro dollar, we're going to see 125 the first half of next year. I think we'll see 130 euro dollar next year. Dollar yen, I think there's stuff going on. I think it's not been allowed to fall, quite honestly. And I think we'll drift back down to 110. But overall, I think the dollar over the medium term, if the Fed is at zero and everyone else is at zero, current account deficit currencies go down. Eurozone runs a massive current account surplus. Japan runs a massive current account surplus. Switzerland runs a massive current account surplus. So the dollar goes down against those currencies. And if we're still risk on, we still have the support of the Fed in terms of liquidity, and it only move gradually, then the likes of the higher beta currencies, the commodity exporters, the Aussies of the world, the CADs, etc., they outperform the dollar as well. Let me just finish off quickly on stocks. Are there? Well, now, so listen to me today, you'll think I'm focused on markets and equities, and I love them, everything else. I hate equities right now. I hate everything in markets right now because everything is overvalued. Let's not kid ourselves. We can, equity analysts can give you these charts about how that stuff is overvalued. Of course, it's overvalued. And this is one way to think about it. So this chart here, this is household net worth as a percentage of disposable income, right? So this is the value of assets in the economy divided by the level of income. This should be a stationary series over time because the difference between those two things is the amount of leverage in the system. And that will change over time, it will oscillate, but the amount of leverage actually is pretty constant, right? And there'll be times when you lend more, lend less, but it should be a stationary series over time. And if you look from 1950 to the mid-1990s, it was. But look what's happened since then. We've created a series of bubbles by having too loose monetary policy. Why do we have the too loose monetary policy? Because there's no income growth, therefore there's no demand. Therefore, the only way we can continue to grow is through inflating the value of the assets that we own and hoping the wealth effect will generate growth. And that's where we are. I mean, basically what we've been doing since then is trying to hide the shift of wealth from the west to the east, which has been going on. And we do that through inflating the value of the assets that we have. So you had .com, then we had the GFC, and now we have QE, COVID, whichever one you want to call it, it's all rolled into one now. But you had equity market leverage, you had housing market leverage, and post GFC, the private sector couldn't do it, so the central banks have stepped in and done it. So that's where we are. So yes, equities will continue to go higher as long as that policy support is there. I don't like them. I think they're massively overvalued. But what I can't tackle is, it's not just equities, by the way, I was going to say it's credit as well. So look at US corporate debt, look at credit spreads, right? Again, people try and rationalize it, they're more efficient, blah, 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 blah. No, right? You've got a load more debt out there, and yet you're getting less reward holding it. That's not a good system. But the fact, what you can't argue with is that the G3 central bank balance sheets have gone from 4 trillion in 2009 to 27 trillion now. You're a big new buyer in the market. $23 trillion has been bought by the central bank since the financial crisis. And the fact is that unless we get inflation, they're going to carry on doing it. Policy will stay loose because it has to. And the only thing that brings the game down is inflation. So going back to your question, yes, they're aware of the wealth effect, but what they're more trying to tackle is income inequality, because you have income inequality, you have wealth inequality. You can solve wealth inequality overnight. Fed can jack rates to 10%, markets collapse, you've closed wealth inequality. No one wants that. What they do is tackle income inequality, which is why they're going for this maximum employment, because they want to let the labour market run hot. They want to get to a stage where the labour market actually is more evenly balanced, and you do have labour shortages. So actually then you get wage increases and you get a closing of income inequality. And that eventually will close wealth inequality. And that's what they're trying to do. They were trying to do it pre-pandemic. The problem is now you have all these supply side constraints that are coming through and making it difficult with inflation. I think they'll stay the course, and I think it is transitory rather than persistent. As I said, their economy's been horrible over the last few years. Maybe I'm wrong, but those are my thoughts, and I'm going to end there so I can leave some time for questions if you have any. So please fire away.
So along that point, I mean, I agree with a lot of what you said. I was looking at it a little different perspective, and that's what my question will come off of. Yeah, reported inflation that the Fed has been looking at has been low for a long time, last 20 years.
Yeah.
And I would argue, like you, it's been driven by globalization and technology. However, yeah, and that's what they're using, and they're using to support, hey, we can push rates lower, lower, and lower. You know, this graph right here, it shows, yeah, particularly QE, but also, yeah, lowering rates in there, is driving asset prices to the moon. And yeah, there's a cost. Yeah, I would argue that this is the inflation in the economy. It's driving
absolutely.
asset prices to the moon.
Yeah.
And yeah, there's consequences for it, for what we're seeing politically, and yeah, everyone can go out by it. But I want to hear your thoughts on, yeah, are they only focused on that CPI measure and those measures, which I would argue being driven by technology and offshoring? And are they not paying attention to asset prices with, you know, rents going up, yeah, by big numbers across the US? I mean, it's causing a lot of problems. And I would almost argue, yeah, back to the original Fed mandate is, yeah, employment and inflation. And in a way, you could wrap that up and say it's social stability. In a way, say hey, those two things are for social stability. But yeah, driving asset prices to the moon like they're doing, and according to yeah your view, probably going further, like they're not paying much attention. They're not. Are they factoring that in their decisions? I guess.
Asset prices are not in their decision, but I mean, I would argue the social issues you're talking about are more about income than wealth, right? People are worried about their incomes. They're worried about their children's incomes being low. They're not worried that somebody's wealth is higher than theirs. I think the income inequality is the thing that drives the social unrest rather than wealth inequality. Because wealth inequality is a paper number, right? And some people have loads and it's increasingly concentrated for sure. And it's exacerbated by QE. But income inequality is the thing that people really worry about. It's whether their wages are going up or not, whether their kids are going to be able to buy a house, or whether their kids are going to, you know, have a job that earns more than they do.
Yeah, that's why I said they're connected would be with house, because house
So
up, rents, yeah, tend to follow.
housing is that is the one that I would say, yes, the housing market is the problem that comes out of this for sure. They're not worried about equity market as such. Housing market is more of an issue. But the thing is, the housing market, this is what you see in other countries, what you see in Canada, you see in Australia, New Zealand as well. You can actually, if you have a functioning political system, you can actually curb housing market growth to an extent through using macroprudential measures. You can limit the amount of borrowing that can be done. You can stop. You can tax second homes, and you can tax investment in housing in order to control the housing market whilst leaving the rest of the economy alone. You can target the housing market specifically. The problem is in the US. I said the caveat was you need a functioning political system. So yeah, I mean, all of this stuff the Fed's doing now, the central bank shouldn't be doing this. They shouldn't be worried about inequality. They shouldn't be worried about the things they're worried about. But it's not happening through the political system. That's the problem. And so the Fed, and people criticize the Fed, they should just think about inflation and everything else. Yes, but their point is, unless they tackle the labour market now, you're never going to get to average inflation of 2% over the long term. You know, we saw that in the post-GFC period. And if I'm right about what it means for leisure and hospitality, what it means for retail jobs, 20% of the workforce, and the technology comes all the time. Another 20% of jobs in this country related to driving. Get self-driving cars coming along, what do you do then with society? So this is what they're trying to tackle, and they're trying to, they shouldn't have to do it from a central bank perspective, and there are unintended consequences of what they're doing, which is asset prices going up in the housing market, absolutely. But I think the Fed's view is, well, what else do we do? They can raise rates aggressively and slow the economy down. Does that help the people? Does that help social unrest if you have much slower growth and possibly recession? I would say it makes it worse.
Yeah, I mean, my opinion, they're sort of in a corner and they're just gonna inflate.
Yeah.
They got no chance. The debt's through the roof.
Yeah.
Like, you can't have asset prices come down.
But it makes it an
So-
unstable system. But if you ever did get inflation, it's ironic if the Fed achieves what they want to achieve, which is more balance in the labour market, that's when we've got problems.
Yeah, I would argue they have a lot of inflation. It's just, it's
It's an asset
monetary
price.
system, and yeah, it's an asset price.
2 years ago, when you were here, you talked about that the Fed should target 1.5% inflation, or your ideal world. I'm just wondering, how did you come to that conclusion, and whether or not it has any relevance to the world?
Yeah, I don't know. But my point at the time was on that, was that we couldn't get to 2% inflation. Right? That was my point. That in actual fact, and going back to the point you were making, that what we were doing by targeting 2%, we were creating these asset market bubbles. And my concern was, well, we've got this unrealistic random number of 2%, which is our target. And by fixating on that, we're creating these bubbles and creating this unstable financial system. I still believe that. I still think we have this unstable financial system. That view hasn't changed. It's just from where we are now in terms, with their new mandate, they've sort of given themselves, they've adjusted the inflation target anyway, right? By going to the average inflation target. I mean, I guess in some ways, compared to what I said before, they've made it worse, but then I can see why they're doing it, in the way Powell's explained it. And the focus on the labour market, I really agree with, because I think that the labour market is key to everything. And the Fed's had a dual mandate for 40 years, but they haven't really. They've targeted stable prices, and the labour market will take care of itself. What we have now is basically they're targeting the labour market, and they're actually letting inflation take care of itself within reasonable, what they consider reasonable temporary range. So, yeah, my thoughts before were about the sort of the unstableness of the system. It's almost the point now where it's so inflated. I'm scared of the consequences if they do become more hawkish. I guess that's probably the fear I have now, that horse that I was backing before is bolted. And so now they've just got to pray the inflation doesn't come and try tackle the labour market in order to make the sort of the economy more balanced, and then we can start thinking about the other stuff. Yeah, sorry.
Follow up on the housing discussion again. There's several analysts that suggest that the increase in housing prices is disconnected from the way that the Fed and the government CPI and housing component in CPI. That therefore CPI is understated in some ways. Do you subscribe to that, or?
No, because I mean the whole housing owners equivalent rents thing is a weird thing anyway.
Yeah.
Right, and you do a core CPI, it's 40% of core CPI is its owners equivalent rents, which is not. It should just be rents, right? This idea of owners equivalent rents, so house prices go up, that means that's higher inflation because what is the owners equivalent rents is people are asked what rent would you charge, would you pay to live in your house? And obviously that's a function of the interest rates and also a function of the value of the house. But it's a weird concept. Just put rents in there, right? That's an expenditure for people, right? Whether the house value goes up or down, we're not targeting. CPI is not asset prices. Rents are something that people have to spend, and I think rents are like oil, in terms of they're a non-discretionary expense. So oil prices go up. That's not inflationary. That's disinflationary in the future because you're still going to put gas in the car, you're still going to heat the house. It means you can't go and spend on a restaurant or clothes or whatever. So actually it's disinflationary. Rents are the same thing. Rents are a transfer of wealth from the renter to the rentee, right? And if rents are going up, then that's actually disinflationary rather than inflationary. And the whole owner's equivalent rent, I think, is a nonsense.
If we just use Zori as a proxy, Zillow Zori index, CPI would be 7% right now.
Yeah, but it's an asset price rather than the consumer price, right? So yes, if you use house prices in the CPI, but then if you're putting house prices in, why aren't you putting equity prices in? Why are you putting all asset prices? Are we measuring goods or are we measuring asset prices? And but owner's equivalent rent has an asset price element to it, and that's where it shouldn't be there.
Basically, just a huge concern with the amount of, I guess, our idea of work. So you mentioned that labor issues are just, people have retired short term. So I've tried to look at the world and, people that have a lot of money and people that just don't, right? Okay. And so the retirement argument bothers me because I see so many low income wage jobs that are not. And I'll caveat this with the last year and a half I've been an Uber driver and my income has raised from like $20 an hour to like $45 an hour. And so when that happened like a few months ago, and it's been steady, like I make $45 an hour driving 38 hours. And so I was like, well, this is clearly going to last a month. They'll throw out some money, and then everybody in restaurants will be Uber driving, and I need to go get a job. But that hasn't happened. And wages on as an Uber driver, this is looking at specific companies' issues too tied into it. But I'm pissed off that more people aren't driving their damn cars than see the music. Like it bothers me so much. And there's so many. And then I'll stop driving at 9:40 p.m. and go to a restaurant to spend my $40 an hour, and they're closed because they're employees. So I can't go spend this money that I'm making as an Uber driver and wanting to go like have a drink because I don't have to go to the liquor system. And so I guess I'm trying to figure out, is there a generational effect that's impacting the lower wage jobs? Like, or what are they tapping to survive? I know their rates are extremely low, and in theory they can borrow money, but a lot of people that work in restaurants don't have to borrow money.
And what they do is they're living on the savings from the unemployment insurance, right? So they'll get $300 a week extra.
Yeah,
And it only ran out at the start of September. Now, I, like everyone else, was surprised that participation dropped in September, right? Everyone was expecting them to come back to work.
Yeah.
They haven't. I think it's a timing thing. I think they're living on the savings, the $300 a week they made extra, and they're living on that. And I think in October, November, we'll see those people come back into the labour force because there's 5 million of them, right? And they don't have the money not to work. So they have to come back to work. They can live on savings now. And maybe there was uncertainty about schools as well, because we've seen, a lot of women have left the labour force since the pandemic started. The schools reopened in September, sure, but then there was worries about they're going to be closed down for 2 weeks. It was very uncertain. I think as time goes on, you will see that reverse as well. So I think it's a timing thing. I don't believe the 5 million people who needed a job 18 months ago suddenly don't need one, right? They've got savings now, but they will be run down.
And then can you back me up on my draconian theory? The United States is maybe I'm worried that we've hit this stage impacted by COVID. We don't view work the same way. So I think that wealthier people have realized that 50% of the days they're working from home, and half the fear that they had to act like they were working is gone because they really actually realize they don't actually have to do that work anymore because basically just making sure they're working. So that's, and I think as I've talked to people on the higher end, that's pretty steady. It's like, man, I can get my job done and have to leave now. And the rest of the time I was just scared that my boss was going to come up. And then, I talked about the stimulus impact on lower income people. But I'm just concerned that that as a country we've forgotten what work and all that. Obviously that's impacted by all the stimulus that's coming. Why should I what do I need to do to make sure my kids know?
I think people will eventually realize you've got to pay the bills.
Yeah.
Right, and that's the thing. And I think, yes, we all think there's been this big shift, and I say, I think that a couple of things have shifted, work from home is going to be a more permanent state, I think online shopping is going to be greater than we've seen before, because the investment's been there. But ultimately, people who want to pay the bills, Christmas is coming up, right? You won't be able to get anything because it's stuck out at LA Port.
So Christmas, we're gonna be.
But I think it's a timing thing here, right? And I think the pandemic is, a lot of people think, oh, well, I don't want to go back to that, I don't want to go back to that. But when the rent's due, they go, they go buy stuff for their kids, wherever, they're going to go back to work. I do think there is just a timing issue there. So I do expect over November, we'll see that participation come back up, later should come back. It may take longer, but that's the sort of, I do think there's just a timing thing on that.
It's like being at a comedy club, I'm in the back at the red light, stand up. We're at 4:15, we'll leave this room for 45 minutes, they have to turn this room over for the evening, so I'm gonna cut you off. Jillian will be here, Lee's gonna be here if you have more questions, please follow up. Thank you all for coming. You will get a member's survey, and please fill it out. Me, I'm the program's chair of the committee, I take that value to your input very seriously as far as time of day and day of week. I moved to a new model this fall. All right, next month will be a lunch, but we're trying out this 3 to 5 model of programs to allow people more time to get here after the close. So I'd like some feedback on that. And most of our events will be here in the Denver Country Club. That being said, if you work in the DTC and have office space and like, oh, this would be great, we've got a conference room, please see me. We are open to hosting in. Thank you, Lee. Appreciate it.
You go by eye right now. I know